Our talk of the tape, where we ask whether the market's 2-month sideways action means the bull market is stalling or merely resting. Let's ask Trivariate's Adam Parker, Wilmington Trust's Meghan Shue, and Wells Fargo's Scott Wren. Adam and Meghan are CNBC contributors, and thanks to you all for helping to wrap up the year for us. And Meghan, let me start with you. I mean, the S&P is right where it was a couple of months ago. There's been some subtle rotation in favor of cyclicals, so it's kind of slowed down, but it's obviously still in a decent position. Is this giving us any kind of a preview for what you expect into next year?
Thanks, Mike. I think it is. I think as we look towards next year, we're expecting a little bit more volatility than we saw, at least for the first 2/3 of this year. A little bit more focus on the source of spending when it comes to tech. We started the year where it was really just all about the AI trade, and investors weren't really deterred by the amount of spending coming from those companies. But now it's really about whether that's being spent from cash or debt markets are being tapped. So I think that's a shift that we're seeing. I think that will lend itself towards more of a focus and better performance from higher quality names, which really lagged last year. But I do think, to your original setup, I think this is a healthy sort of churn as we reset for the next leg of the bull market, which we expect to continue outside of what we still have as a decently high recession risk.
Right. Yeah. So that's the interesting maybe contrast there, or at least juxtaposition of the macro outlook with how the market is set up. Adam, I feel like you always have a pretty good feel for what the market's rewarding, what themes are kind of coming out of the action in terms of what it shows us about investor preferences. So what would you say right now are kind of top of mind in terms of what the market is revealing?
Hey, Mike, thanks. Yeah, I mean, I think a lot of it comes down to margin expectations and estimate achievability. And the reason I say that is we just came through a stretch in the last 6 months of 2025 where the penalty for companies missing estimates was really harsh versus history and much worse than the reward for beating. So it didn't matter. Expensive stocks that missed went down the same amount as cheap stocks that missed. So it wasn't valuation that mattered, it was missing that mattered. So we kind of are looking now, kind of scrubbing the 2026 estimates, and they look pretty optimistic. So I think the problem or the challenge as we kind of rotate the clock a little bit is I think the probability of multiple expansion is probably lower than the probability of multiple contraction, and we have high estimates, and we have a bullish set of sentiment. So it's not the same setup as it was, 6-9 months ago.
And so is there a way, I mean, I know you say you're scrubbing the numbers, but are you basically trying to isolate where the earnings achievability seems to be, or is you just kind of looking at the trajectory of forecasts and figuring that the revision story is going to tell you what you need to know?
Well, we do pretty quantitative stuff at Trivariate Research. So one of the things I like to do is look at what we call the incremental margin, or the margin on revenue above today's level. And we do that by doing a regression between the change in sales and change in income. We see what the company usually could do for their margin on new revenue, and we compare it to what's in the estimates. And we use that as sort of a barometer for estimate achievability. Obviously, margins come down to revenue, and that's pricing and mix. They come down to costs, which are labor, materials, logistics, currency, depreciation, et cetera. Mm-hmm. I'm a little worried that you got mid-teens earning expectations, a lot of companies expecting margin expansion. I get AI productivity is going to go from hitting 5% to maybe 15% of the S&P 500, but the bar is not as low. And what was unusual about 2025 is estimates came up. I mean, they're higher now for 2026 than they were in the middle of the year. That's a pretty unusual pattern, as you well know, and have been writing about for years. So I think that the mix here is company by company. I think healthcare estimates do look more achievable than average. I'm a little bit worried that in the consumer discretionary sector, as an example, every single industry in there is expected to have accelerating revenue, despite the fact we've got very low confidence if you look at Michigan consumer and other things. So I think it'll come down to stock by stock, but I'll say healthcare looks a little better to me than discretionary as sort of a first glance.